Tips on how to finance a business purchase. 1. SBA Loan. SBA loans are made by banks to businesses, and they offer competitive loan terms and low interest rates compared to conventional financing options. You can apply for a Small Business Administration (SBA) loan through a lending institution such as a bank or credit union, which then submits an application for a loan guarantee to the SBA. What are the pros of SBA loans? Lower interest rate. On SBA loans, interest rates are made up of a base rate and a percentage added on by the lender. Lower upfront fees. The SBA has strict caps on fees that lenders can charge when originating an SBA loan. Lower down payment. Down payments on SBA loans can be as low as 10% of the purchase price. What are the cons? Lots of paperwork. Stricter underwriting requirements. Small Business Administration (SBA) loans come with some of the strictest underwriting requirements that small business owners can face, including a credit score of 680+ and strong personal and business financial history. While the SBA does not make the decision about whether or not an applicant will get approved, they do play a major role in determining how much money an applicant is eligible for. SBA loans are primarily advantageous to self-funded searchers. If you get qualified for an SBA loan, this could save you time from having to find outside equity investors or other conventional lending providers. A pre-approval letter from your SBA lending institution could help you close the deal faster once you get an opportunity under LOI. 2. Conventional loans, leverage buyout. Using conventional loans is most common if buying a business for over $5 million. There are two types of conventional-based lenders. One type makes loans on specific assets of the business, or commonly known as asset-based loans, and the other is called cash flow-based lending. 3. CO investors. Another common way of raising capital is raising money from other people. These people could be friends or family, other people you may know in your network, or accredited investors. Wealthy individuals, angel investors. If you don't have a network already of wealthy people to call upon when raising capital, there are a couple of ways that you can track down equity investors. One way you can attract outside capital for your acquisition is by using Investor.com. Investor.com allows finding equity investors based on industry, investor type, size of funding, and location. Private equity firms. Another way to raise money is to partner as co-GPs, general partners, on a deal with a PE firm. An example of how this would work is, let's say your investment firm is looking to acquire plumbing companies in the state of Texas. After months of searching, you find a plumbing company that is willing to sell to you, and now you have the plumbing company and an LOI, letter of intent. Once you have an LOI signed by the seller, you can shop around for another potential partner for the deal. Family offices. Often, a wealthy person or family creates their fortune through having domain knowledge in an industry. This knowledge can be applied to running a business, creating valuable relationships, or simply thinking strategically. By setting up a family office, the owner can maintain some degree of influence over his or her assets and also help to generate additional value once they're invested. 4. Seller financing. A common form of financing used by buyers in an acquisition is seller's financing. Sellers typically provide a loan to buyers who want to buy their businesses. Buyers pay back the loans in installments, with a percentage of each installment going towards paying off the loan. Essentially, the seller acts as a bank and carries a portion of the note which the buyer will pay over time. Seller financing example. Let's say Jack wants to buy a plumbing company from Nick. Jack will primarily be using an SBA loan to help fund the purchase of Nick's business. The minimum down payment on an SBA loan is 10%. After a fair amount of negotiation, Jack agrees to buy Nick's plumbing business for $1 million. Jack then gets approved for an SBA financing, but Jack is only able to do a 5% down payment on the $1,000 purchase price. Jack will have to find an additional $50,000 to meet the SBA requirements of a 10%, $100,000 down payment. Jack decides to ask Nick for 50% seller financing. Nick says no, but Nick eventually agrees to a seller note of 10% of the purchase price. This is great because seller financing can be used as part of the initial down payment. Jack is now able to meet the minimum 10% down payment requirement, with the seller providing 10% standby seller financing on top of his 5% cash infusion. Jack can put a total of 15% down. 5. Earn-out. An earn-out is a type of contract where the final amount of the sale is either wholly or partially contingent on the company's performance over a specified period after closing. Typically, the purchaser will be obligated to make payments to the sellers based on pre-agreed upon revenue milestones. If the company does better than expected, the buyers will owe the sellers more money. If the company does worse than expected, the buyers may owe the sellers less. Earnouts can be used to incentivize companies to perform well during the transition period between selling and buying. Earnouts allow the buyer and seller to bridge a valuation gap and structure a deal that can benefit both parties. 6. Home equity line of credit. A home equity line of credit could be a beneficial type of acquisition financing. If you own your home outright or you have equity in your home, and good personal credit, you can apply for a home equity line of credit, HELOC. Banks typically charge lower interest rates than traditional loans, so if you plan to borrow money for a short period, a HELOC might make sense. To get approved for a HEL, you may need a credit score over 660 or greater. Lenders typically offer between 90% and 95% of the value of your house. At iGOTHAM, we partner with private equity, family offices and independent sponsors to co-invest on deals.